All right, welcome to the third day of John McEntyre Show live, and we're glad to be here. We're actually receiving a lot of good input from everyone, and we really want to, and I appreciate that. Let us know that we are giving the information that you are looking for out there in the marketplace. And with me, I have Andrea. She's with me today, and we will be doing a continuation of the actual creating a sound financial foundation. Today is part three of that. And before we actually get into that, well, we're going to play an actual recording, another clip of the recording that we had completed. And so before we get into that, though, Andrea, we were wanting to let our viewers know about a wallet win. It's a good story on a wallet win that we actually experienced yesterday. So what we got?
Well, I'm glad you mentioned that, John. Um, Thanks, and we encourage everybody to keep sending in those hashtag wallet wins. So
Yes.
one that is pretty exciting for me. A lot of people have paying off debt as
Mm-hmm.
one of their goals. Well, this person was able to not only pay off a large debt that's been glooming over their head for a while, they were able to pay it off two. So the person received the alert, as many people did, that their student loan had been paused, and they actually were able to receive student loan forgiveness.
Mm-hmm.
So, with the money that they were prepared to start repaying, actually had started repaying in October.
Mm-hmm.
They were able to take that payment and then apply it to their credit card. So not only is the student loan forgiven, they also were able to accelerate paying off one of their credit cards. And now the payment for the credit card and the previous student loan payment,
Mm-hmm.
those are now being applied to their next debt. So they're well on their way to eliminating the debt and just taking advantage of that acceleration with money they were already setting aside for that goal. So
Oh, that is
great.
a That is a great one. We always want to hear those student loans because that one that student loans behind healthcare, they're not as dangerous to the financial plan, but they have hindered a lot of people's financial goals because they're not able to do other things because they're so busy, taking care of their student loans. Even though healthcare, you can actually be garnished. They can actually force you to pay them. Whereas in, student loans, it can be, but people just don't see those as being, more dangerous, even though they are to a financial plan. Too much debt, too much of any type of debt can be bad, on your financial plan.
Well,
So.
it's on your financial plan is one part of it. The other part is on your mental health because it adds on stress, and that
Mhm.
extra stress from financial pressure can
Mhm.
impact your overall health as well.
That's right. That's right. All right. So that was a good wallet win for us. So and we're going to move forward with actually doing our running the clip on the creating a sound financial foundation. And so enjoy this, and then we'll come back and we actually have a couple of questions to answer. So.
Yes. So I know I covered term insurance, I covered permanent insurance and final expense. All of those are combinations that can be used individually and along the way. Group insurance falls under the category of term, it's just under a group plan with your employer. So I wanted
Right.
to
So
do
that's
that.
your work. So pretty much all work insurance, work related insurance is term insurance. Is that what you're saying?
Yes. Yes.
Okay.
So it will end at the time of your employment unless you decide to convert it into an individual plan,
Okay.
which means you're going to pay a higher cost than what you paid when it was deducted from your paycheck.
Okay. So you can take it with you. It's just going to cost more.
Exactly. And from experience, I've always taken advantage when I was, working at different positions, and but I always overlapped my insurance with my own individual plans because I
Mhm.
wanted to make sure, no matter what may have happened or changed, I had a plan for my family, and I knew that insurance was not enough to cover our plans and goals if I was to pass away early.
Right. And then on the other side, I remember buying the years ago, buying the because I have term policies. Well, we both do term insurance. And so you mentioned ladder earlier, uh, earlier when you was talking about the life insurance. You know, that's what we did. You know, we just laddered, basically stacked insurance, because some people, they don't, it once they buy a policy, a lot of people, they will just, okay, I've taken care of that, and then they move on to the next thing. So when you talk to them, oh yeah, I have insurance. Okay, when did you buy this insurance? Oh, I bought it when I was 30. Okay, and how many children did you have? I just had the one. I had the one newborn. They were just born at the time, so that's why I wanted to buy insurance, which was a very responsible move. Okay, so what do you have now? It's 10 years later. Oh, I have 3 children. Okay, and you have a larger home, and you have this, and you have that, and you have a much larger lifestyle. Do you want your family to still have that lifestyle if you passed away? Well, yes. Okay, the insurance you bought at 30 years old will not cover it now.
You're right.
So
You're
people, they don't.
100%. So just like any, looking at your spending plan to make sure that you're on track
Mm-hmm.
and that your expenses that you're spending and paying yourself on a regular basis, and then you may adjust where needed.
Right.
Your goals and your protection needs to be adjusted as well. You want to make sure that you have the situation covered where, as your life changes and your goals and dreams have adjustments, that your protection is growing with that.
Mm-hmm. That's exactly right. So with life, you said it, you touched on it earlier. So someone's out there saying, okay, I know I need life insurance. So how much life insurance do I need?
That's a great question. As an average, and I do want to say this is as an average because every individual situation will be a little bit different. But on average, you want to have at least 10 to 12 times your income, your total
Okay.
income.
Okay. Okay.
And if you're trying to do this alone, which it's fine to do, we have a lot of do-it-yourselfers, or if you're wanting to work with someone, I'm happy to work with individuals as well. Well, one of the exercises that we do is taking a look at your entire financial picture, looking at what are your assets, your liabilities. So we're putting together a basic balance sheet, and we just want to take a snapshot of where you are today. By doing that, it helps us see not only what assets and liabilities, the things that you own that has value, and then the things that you owe. We also want to take a look at your goals. What does it cost to fund your goals? All of those things help with confirming that the 10 to 12 times is enough. And if it's not, there may need to be an adjustment above that. So that's
Right.
why I was saying you start there as an average, but we would certainly want to make sure that it's customized to fit your situation.
Okay. Yes, because the philosophy that I was taught, one of our mentors, um, he taught me. He said, "You look, you're young. The way you do life insurance is any insurance. You buy it when you don't need it, because that's when it's at its cheapest." He said, so if when you get older, and he set me down and he showed us both. He was like, look at this. He said, you buy the policy today, look how much it will cost, and look how much it will cost if you waited for 10 years. He said, even if you're healthy, look at the premium cost. He was like, so, buy as much, and grow into it. So that's the way I saw it. I was like, okay, we'll buy these big policies and grow into them, and then later on, if we need more insurance, we'll have the money to be able to purchase more insurance. But we're growing into this, so we're never above our insured. Our lifestyle will be insured as we're growing.
I'm glad you brought up that example because I 100% agree and value that education. I also appreciate when I've worked with clients who are on the backside, let's say their career, and they're doing their review
Mm-hmm.
to look at their full financial situation, and they're evaluating their type of insurance. Because what the type of, let's say, health insurance needs that they previously had when they owned their business or were working their way within corporate, executive, whatever that role may be, um, their those needs have changed. So their health has changed as well. Some of them have had a scare and they get healthier. Some of them have just moved along and haven't had any major changes. So they didn't notice when there was a slight decline, and they started developing small issues along the way.
Mm-hmm.
But they're on this side of the sun, so they feel that they're winning. And in a way, they are. They absolutely are. But they're on the backside of that career. What I'm getting to is they're evaluating to see, do I still need that same amount of insurance? Has the type of insurance that I need, does that need to be adjusted? So they may be shifting from term insurance, and they may consider having a portion of that to be either permanent insurance or a different type of insurance, because maybe they've paid off things and their debt and their expenses has been reduced. And then they also want to lock in, again, like we mentioned, you're doing a review, you're stacking, or you're converting insurance into different forms. So now that insurance is able to work differently for you. Not only is it protecting for the what if, but it has some investment capabilities as well. Then there's situations where it's the complete opposite. They're making the change because they have to. The crisis has happened. And so they may secure final expense insurance or some type of permanent whole life insurance policy that they know will cover their situation. And they just want to make sure they have enough to bury them and maybe leave something for either um, an important church, foundation, organization, if they have or don't have family members to pass something along, because they're on the other side where they're evaluating what's next.
Right. So, and that brought up another point. A lot of people, especially when they're younger, and I was in the same, I was in the same boat. When you're 18, 20 years old, 25, you feel you're going to live forever. And we have friends that didn't make it past 25, extreme healthy, healthy. And, saw one day we're laughing and talking. The next day we get the call, killed in an accident, it's primary life, or diagnosed with cancer in their 20s and didn't like make it through or whatever. And so, as sad as that sounds, talking to some of them was, I wish I would have planned a few things better, because now they can't exactly, they could, but it would be very expensive. Can't get the insurance because they have cancer now, or they passed suddenly and didn't have any insurance. So I said that to say, if you're, a lot of people, they will ask, how old should I be, before I buy insurance? Well, it's really not an age thing. It's, what's important to you. That's our question. That's one of the guiding questions, to the show. We built careers off of that question. What's important to you? You have a 20-year-old that loves dogs, and their home is one of those homes for emergency, adopting a pet,
Mm-hmm.
in a crisis situation and everything. And so, and they support, they give, they take a portion of their, they not only do they adopt pets and provide the emergency shelter for them, they support the local, animal shelter. Okay, so would you like to keep supporting that shelter, that particular shelter, if you passed away suddenly? Well, sure. Well, life insurance will do that for you. And so
Absolutely.
some, they don't think about it that way.
Absolutely. The other is to you didn't say it, but I want to give a word to it. You want to protect your insurability.
True.
So protecting
That's
your
right.
insurability, you were saying when someone is young and they're healthy, feeling invincible, superpower complex. Um, they think that they will never die and they will never
Right.
have aches and pains. Um, they will have a rude awakening
Believe
as
me.
they
Oh yeah.
mature. Just
Believe me. I have my
just
good
getting out of
days and
bed.
my bad days. Right. That's right. You know, I know a comedian was saying it. When I was younger, I jump up out of bed and I go through my day. So now, now that I'm older, people are like, "Why are you in that body cast?" Oh, I stretched wrong. I mean, I got up out of bed and I stretched wrong, tore all my ribs, all of that. So, you know, I said,
Well,
is it funny?
God,
But it just seems just like yesterday, I was one of those jumping up out of bed, just hitting it, going to the gym and everything. Now, I have to, that extra cup of coffee, a little bit of this, a little bit of that, then I can get out the door. So I'm here to talk to the younger people. I'm quite sure the older people, they can, they understand where I'm coming from. The younger people, it happens in a flash. It happens just like that.
yes, you wake up one day and realize uh, that things get sore very quickly, the wrong move. Or if you don't have your workout clothes by the bed, you'll wake up and forget what you were supposed to be doing, or your mind will make you move slow. So because you really don't want to go. So you have to build in things to help you. So when I was saying protect the insurability, so one of the things before they have family, but they do have passions and interests, and I love the example that you gave. That
Mhm.
person absolutely can make sure that they're protecting their insurability. They lock in that good health rate, and it can help that if something happened tomorrow, that it would go towards the organizations that they're passionate about. But let's say over time some things happen and they now have a partner and they have a family, and um, they've also, that insurance may have a new purpose or reason, maybe a smaller amounts going to that cause, and then the majority would go to the family members and towards this next phase in their life. They've locked in that health status, that lower rate, and that can pay off because I too have some examples, and one that I think about very often is a friend of mine that I was working with very early. The guy loved marathons, extremely healthy, very active, just fun guy. And he was out for a run one day and he tripped and ended up having a stroke. And he was only 32. And when I think about my friend Russ, it's just something that you just never know. And he was healthy; he was the picture of health, and him having a stroke was something that no one ever expected. And he now still, as he continues to mature and get older, along with the rest of us, he has complications that did not show up initially that are now showing up later. And had he not had insurance and some things in place, his now family would be in a situation where they couldn't take care of some of the goals and dreams. That
Sorry for the technical difficulty there, but we only missed like a second. We covered all of the points of the story that Andrea was telling about her friend having things in place to be able to take care of the situation, right?
Yes, yes. Bottom line is, Russ was happy that he had some insurance in place early on. He was just starting his career, young family as well. So the having that stroke, because he had pre-planned
Hmm.
and he did have some insurance, It wasn't as much as he probably would have preferred having, but he at least had a foundation, a baseline. And then as his family and plans grew, he was able to acquire more. It was just more expensive.
Okay. Okay. Well, there was some good information that was covered there. Now, before we wrap up the show, we always want to end answering a question or two. And so we had a very good question that really ties into what was being discussed here. And the question, we was talking to someone, and they was actually talking with their parent, and well, I think it was the mother, and realized that the mother had other types of insurance, but did not have life insurance.
Hmm.
And so their question was, can the child buy insurance, life insurance for the parent?
Yes, yes. And I do want to make sure we're discussing this situation clearly. So this is a mature mother, and this is an adult child. So someone over 18 that wants to buy insurance for their parents.
Yes, yes, yes. The child is over 18. Yes, they're much older. They have a family and everything. And the parent was 80, actually 80 years old. And they thought that, first of all, they thought that they were uninsurable because of their age, that they no longer could have buy insurance for them, and they didn't know if they could actually purchase it for them because the parent is on a fixed income.
This is a great situation, and I see it come up a lot. So um, I would like to kind of walk through this example. So the great news is the adult children can purchase insurance for their parents.
Hmm.
They could be the owner. They can pay for the policy. There's depending on the type of insurance protection that they're putting in place, they do have a lot of options. So that's the great news. And
Okay.
then there are also different types of insurance options that they can look at. So depending on, let's say this person, it sounds like their health uh, had been declining over the years. They also were getting older, and they were
Hmm.
just concerned that I'm not healthy enough and I'm too old. So
Right.
there is what's called guaranteed issue final expense
Okay.
insurance.
Right. Right.
There's also what is called simplified, or you may go through um, fewer health questions.
Hmm.
So the guaranteed issue final expense, that type of insurance means that you are guaranteed that you are able to purchase insurance. You will have a fixed premium. It'll cover you for the amount of time that is needed, and the adult children can pay for it. So we, a lot of us have seen those commercials. Well, they'll say guaranteed issue, final expense. Type of policies. And I do want to make sure that everyone understands that you either need to do your own research or you need to work with someone to make sure you understand, because each type of company, there are different types of policies. I worked with someone recently, similar situation as this, and I know that AIG has one that is guaranteed issue, and there is no underwriting process. So nobody comes out and does a medical exam. No one's calling to go through medical questions with you. You answer some basic questions. You need to be truthful, and there's a process that you have to fill out, but as soon as you answer those questions, you prove that there is insurable interest if your adult child is owning this policy and the premium is paid. Once the premium is paid and you acknowledge and receipt the policy, whether it be physically or electronically, you are covered. So they had peace of mind immediately. So in this situation, they can have peace of mind immediately. Then there's the situation I mentioned, which is simplified issue, or it may be simplified or fewer underwriting questions. And what that means is instead of you having a full medical exam where someone's coming out and they're doing your blood work and urine and they're going through that process, there's a shorter list of medical questions. And so they may have certain questions that they're asking. And if you said no to all of those, then in that particular case, they're going to run your background. They may call and confirm the information, and then you pay your policy once it gets goes through a shorter underwriting criteria. Your policy, once you pay the premium, it is now in force as well. So there's a cost difference and a little bit of a price difference between the process. But I say, if you know that if you think you have a lot of health concerns, don't count yourself out. If you think because you're 79 or 80 that you're too old for insurance, don't count yourself out. You don't have to um, you don't have to consider cremation. Um, and I have a question for you, John. When you were working with them in that situation, what was driving the parents, um, nervousness and concern about not having, life insurance or something in place for their funeral?
We had the conversation more and more. The parent, it just came down to the simple fact that the parent just did not want to be a burden to their family. They had seen family, when you're 80 years old, you've seen a lot of death, you've seen a lot of different situations, and as we've discussed, they didn't like the fact that their children and family wouldn't be able to like mourn and really have have the good thoughts and be a family, because they were concerned how they were going to pay for a funeral. And
Mm.
so the parent had actually talked with I think one of the funeral homes about the process of being cremated and what the cost would be, and they were going to start trying to do like maybe paying a little bit up, prepaying is basically what they were going to do, prepaying, because cremation is cheaper than actually doing a full funeral ceremony.
Yes.
And their child, the one that I talked to, did not believe in cremation,
Mm.
and just come to, and then as we talked more and more with the parents said, well, that was the cheapest thing I could afford, that's all I could afford. And so that's when the child was like, well, I will pay for the policy, I'll take care of the policy. I don't believe in cremation, and I know that that's not what you want anyway. And so they were able to sell it, and no problems at all. So it was a good thing to see that actually happen. The parent did not want to be a burden, and the child was not treating them like they would be a burden. So it was a good outcome.
Absolutely, absolutely. So I hope that helps everyone know that whether you're young or you're
Mhm.
older, there are options that are available to make sure that there's something in place so your family is able to mourn you and take care of your burial. And in some cases, they may have uh, a little bit extra that they're able to maybe contribute to, whether it's the family overall settling any type of debts or things, or in some cases maybe even taking the remaining balance to apply towards, let's say, your church, or endow um, your library, or the humane society, or other things that may be important to you. So covering your funeral and making sure that's in place, that's one piece. And then there's also sometimes an option that the extra can be provided to family members or to something that's near and dear to you.
All right. Yep. Very good. Those are some excellent points made there. And so, if you do have any questions, don't hesitate to contact us. You can visit us. Go to the website, contact us at www.johnmcintyre.com. Reach out to us through our social media feeds, or you can actually email us or just give us a call. So we're going to wrap it up there, and tomorrow we will be back, and we will continue running our creating a solid foundation, financial foundation. We have a little bit more left, and then we will share some wallet wins, answer a couple of questions, and and we will hope that you have received something useful to help you with your financial life. So, on behalf of John McEntyre, Andrea McEntyre, until tomorrow, we'll talk.